Market volatility. Those words sound so academic, so benign. But the fear and uncertainty such volatility engenders is real. Unchecked, our minds can race to fixate on the worst case scenarios. And given the significant market declines we all have experienced, whether the bursting of the tech bubble, the great financial crisis, or even the brief but deep COVID-related sell-off, it's easy to understand why worst-case scenarios might not seem that implausible. But if we look back over the longer history of the U.S. stock markets, over, say, 40, 70, or even 100 years, what typically follows declines of at least the 18% we've just experienced? To answer that, today we examine the nature of historical S&P 500 declines, how long they normally take to bottom, how long it normally takes to then reach new highs, and specifically measuring from that 18% decline triggering day, what tends to happen at the 3, 6, 12, 36, and 60-month marks thereafter. Equipped with that insight, you'll be better able to check your emotions and make rational decisions about what to do or not to do next. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We are ready for a great episode and great topic for today. I think it's really, really timely and useful in the current market environment. Gentlemen, before we jump in, how are you doing? Anything new in the last week to report?
It was good hanging out with you over the weekend, Roshan. We got some dinner with some of our coworkers on Sunday, so that was fun.
That was
Yeah,
nice. Erik, we need to get you in town for one of these.
I know. I don't know when my next trip is. I try to usually get out in Octobers, and because I have a brother who lives in the city and or near the city, and so just haven't done that the last couple of years. So I'll tell you what, let's make an effort at sometime during the playoffs, baseball playoffs, to get together. Speaking of baseball, the lowly San Diego Padres are tied for fourth place right now for the best record in baseball. So I just,
Nice.
it's a fun time. It's a rare thing, but it's a fun time to be a Padres fan.
Who's their best player
Well,
right
they had
now?
a
Manny Machado, without a doubt, and they're pitching. They're starting pitching. There's 7 starting pitchers right now, and so what they're doing is taking their number 4 and 6, their number 5 and 7, and they're having them split games. So
wow.
it's amazing how flush they are with good pitching this year.
Well, that's great. I know Adrian and I are watching the NBA playoffs right now too. The Heat just beat the Celtics in a bit of a blowout for Game 1.
Oh, really?
Yeah, I'm
Well,
really looking
Yeah,
forward to the Eastern and Western Conference Finals. Hoping to see some good plays and some close games. They haven't been really too close. Some of them have just been pretty one-sided, but there's still time for some really good games. So I'm looking forward to it as always. And if the Padres come into town and are playing, I definitely have to try and get tickets to see them, Eric, since you're such a big fan.
okay, let's
yeah,
hope it somehow coincides with the next time I'm visiting. In fact, maybe I should just structure it. If they're playing the Nationals, I should fly in.
Yeah,
We'll just look for the date when that
that,
might happen.
that's a good idea. Nationals or
that would
Orioles, those are both close. So
Oh, that's
I'll
true.
definitely be down for that.
Oh, yeah. Okay,
yeah.
fantastic. All
Yeah, they
right. Well,
took Machado from the Orioles too.
yes, that's right. So, yeah, we were playing Philadelphia last night, and oh my goodness, were the fans there booing? Apparently, they're very vocal opponents, high spirited opponents. Let's put it that way.
Yeah, Philly fans are known for that, and I believe this is still true, but they're the only stadium with a jail for the I don't know if it's just it used to be the veteran stadium and now what's Lincoln Financial. But I believe they still have a jail and I believe they're still the only city with that right in the stadium, football stadium. So yeah, be careful with those fans.
Those are some serious fans, but they love their teams, ride or die.
Yes, that they do.
That's funny.
So, gentlemen, let's jump into it. I think this is a really valuable topic for today. For everyone that's listening, we want to talk to you about where the market is right now and how you can get through this highly volatile time. We've got some thoughts on where we stand, and then we're going to talk a little bit about, well, what can you do about it, or how you can handle this and make sure you get through to the other side. Eric, you've got a lot of great stuff to share. Why don't we start with some of the information you've got, some of the things
Mhm.
you've pulled together for where we stand currently.
All right. Well, great. So, listeners, we know that many, not all of you, but many of you are at this point experiencing, understandably, the stress of what's going on here. We've been listening to news about inflation for quite some time, interest rates for some time, now rumors of wars, and then actual war in Eastern Europe for some time. And as a result, people are wondering what is actually happening here. I wanted to do was to step back and leave aside the immediate catalysts and the discussion of those catalysts. We've done that in previous episodes. If you want to go back and look at the all episodes tab on our website, retirementlifestyleshow.com, I was just noting this morning that a couple times in March, a couple times in April, and once again in May, we had talked about various aspects of this: wars, interest rates, Fed actions, and so forth. But today I wanted to instead deal with more just the raw fact of the decline that we've had, and historically at least, what has subsequently happened in the US stock market after those declines. Let me be more specific. We just triggered last week a decline point from the immediate previous high. We set in a decline from that previous highest high ever of just over 18%. And then we've had 2 or 3 days of rebound. We have yet to know what today will bring, but nevertheless, I thought, all right, we've just had an 18% decline. Let's look at what happened at all other instances where the market, from its highest prior high ever, had put in at least an 18% decline. So the day that it triggered, whether it was 18 or it blew past 18 and it went straight to 19 or 20 or whatever, but what from that moment when it triggered the 18% decline mark, what subsequently has happened. And we're going to look at some graphs. So those of you who are listening, not watching, we will have these graphs in the show notes, but also you can look at this on our YouTube channel, Retirement Lifestyle Show YouTube channel. And you can also see the video versions again at our website, retirementlifestyleshow.com. So I think these graphs will be helpful, though I recognize many of you are just listening and will not go to see the visuals. So I'll do my best to give you an ear picture of what others are able to see. But let's just start with this.
Yep.
So go ahead, Roshan.
And Eric, as you're pulling that up, I just wanted to mention just a couple data points. For one, there have been 28 bear markets since 1928. I know we're not going that far back in the chart, and you're
Mm-hmm.
looking at the
Mm-hmm.
18% number. The average decline was 35.62. And in the last 19 of those bear markets, the decline's been about average of 37%. The duration of those declines, as far as how long it took to go down, the median is 18 months, and the median for months to recovery is 20 months. So I know we're talking about 18 because that's where it is. That's where we stand currently, and there have been declines that have been 18, and that was it. I just want to make the point that one, there could be more time to go, but if we look at the median 18 months of decline, you know, we're roughly 6 7 months in already. And if we look at how long it took to recover, it really wasn't that bad, right? So let's start with the data set you've got. But that's sort of my overall theme when we go to the
Mm-hmm.
historical data is one, this is just a part of investing. And this, what we're experiencing right now, is not an anomaly, it's more the norm. I think that's important for people whose bear market or market decline experience really only stretches to COVID, right? Because that was the fastest decline in recovery in history. So if that's your only data point, this is looking like it's something strange and out of the ordinary, and you're expecting something to happen quickly. And that's typically not the case. That was extremely rare. Um, but Eric, please
That's a good
share the
point.
screen and look through the
Well,
numbers.
actually, let me just follow up one point before you did. So I just want to make sure that the listeners understand and that I understand. So you're saying that the study that you did showed that the median length of time from the peak to the valley was 18 months. That's the median. And for our
The
listeners,
median, correct.
listeners again, median is count from the highest to the lowest into the middle, and whatever the middle number is, that's the median, as opposed to the average. It's slightly different, and
And
it's
actually, yeah, the average, by the way, for that is 21 months. For the
mhm.
bear market duration, the average sort of line isn't too far off from the median.
Okay.
As you were saying, the median being the midpoint versus the average. The recovery time in terms of months, you do see a significant difference.
Okay.
And that's from the bottom, how long it took to get back to its peak. The median is 20 months. The average is 44 months. The reason I'm sharing or looking at the median more than the average or the mean is because on the recovery side, um, during the Great Depression, it took
Yes.
268 months,
Right. That
right? So
drives
that
the
data
average
point
up.
is just really skewing it.
Yes.
Yeah, and
Right.
and the numbers show you that, right? It more than doubles the average, the median more than doubles, from 20 months to 44 when you go to the average.
Yes. Okay. Well, thank you for that. That does put that's helpful. So let me also just note, since Roshan, you said this is more normal. It really is. I'm going to be showing this in just a second, but in terms of just the normality of it, we have since the 2008 decline, and most investors remember that. Most investors remember that. But since the 2008 decline till now, it's been almost 14 years. Yes, we've had three such declines of 18% or more, but two of those recovered almost instantly. Those were the ones at the end of 2018, and then the one at the beginning of 2020 in response to COVID. So we don't have a recent memory. It's a 14-year-old memory of a deep decline and a long recovery. But even that wasn't long by the measures that you just cited. So, but listeners, the other thing that's going on right now and that we want to acknowledge is that we're having at this point not only the decline in the stock market, we're also having a decline in the bond market. And at least on a year-to-date basis through April 30th, this is the fastest on a calendar year basis that the bond market in the United States has declined this fast by this date, April 30th, that we're using, since 1842. So when you couple those two things, you're not getting the usual dampening or inverse effect of bonds working for you, and so you're feeling more the pure throughput of both sides of your portfolio under a bit of strain. So we understand that, but let's look at these numbers. This is the S&P 500 that I'm about to show, price data only. So I'm not showing the reinvestment of dividends and the effect that that would have had. The effect of that, incidentally, would have meant for a faster recovery and a shallower decline. But so we're stating it in just price terms here. And I want you to see what has happened here. So let me go ahead and share my screen, and we'll go to this window first. So what listeners, I'll describe this both for you and for our viewers. What you're seeing here is a logarithmic graph of this price movement of the S&P 500 since the 3rd of January of 1950 all the way through yesterday, May 17th of 2022. And that's the blue line that's jagged. Floating on top of that is a red line or an orange line, let's say, that resets and then travels horizontally until it bumps into a new high, and then it rises with that new high, and then it shows where that new high was, and so forth and so on. So it's sort of like a step ladder, growing higher and higher, but then getting horizontal once a new high has been put in. And then below that is a gray line. That gray line is running from that moment at which, on a closing basis, the market had a close that was at least 18% below the prior high, which is again signified by that orange vertical or orange horizontal line. Pinpointing those moments at which at least an 18% decline was first established following that highest high are these vertical gold lines. And you don't need to count them, but you'll see they're fairly evenly spaced at first, and then they get a little bit more staggered. But there's 14 of them in that 72-year period, the last one just having occurred this last week. So do the math on that. If there's 14 and 70 some years, it's roughly every 5 years that this comes about. Granted, we've had more than our share in the last few years, from the end of 2018 until now, which is 3.5 years. We've had just now our third, so it's feeling like we're getting more than these than we probably would like to feel. But that also comes after quite a dry spell from no such declines of that magnitude since the bottoming process of March of 2009. So what does this mean then? So there's the pattern. There's where these are triggered. What happens after those instances on the day that it closed below 18% down? What happens next? Well, this next graph shows that. This shows every single one of those 14 times. Now, in one of those 14 times, we're just 3 or 4 days into it. So you on the far left side, you can't see that very clearly. And the one from of March of 2020 with the COVID crisis and the market's reaction to that, you can see this sort of, I don't know what you'd call this, sort of peach colored one that rises up pretty high here at day number 421 and then finishes and doesn't really show much more after day 568. That's that event, and so forth. And the one that was before that, from Christmas Eve of 2018, that's this blue one that kind of skies out here and then stops showing any further progress after day 841. So those are a couple of the very, very most recent ones, but all the rest are shown in there, and the actual path day by day by day. This is from the left side to the right side. If they went all the way, that's 1,260 days of trading, which is the same as 5 years. 1,260 days is 5 years. And so you can see kind of what was happening 3 months in, a year in, and so forth, all the way over. Let's isolate, though, some of those patterns, just because that's a pretty noisy graph with 14 lines running through there. Take out the last three, the one from Christmas Eve of 2018, the COVID decline, and the decline we've just now had. On any given day over that 5-year ensuing period, from each of those, starting day 0, and then the next day is day 1, and so forth. The highest that any one of those lines ever reached is shown here by this blue, and the lowest that was ever reached by any one of those lines is shown in the gold. But the most interesting line in this mix, it seems to me, is this mean line, or the average pathway. What you see is that the average pathway, about a month in, on average, you're still at about break even. But at about 3 months in, that's day 63, you're up about 8%, something like that, maybe 5 to 8%. And by what would be essentially around 2 years in, which would be a little bit past 500, you're up about 26, 27% on average of those the earlier 11 out of that group of 14. Now, I know statistics, and I understand that 11 isn't exactly a giant sample size, but it is the sample size that we have for the last 70 years. So I'm just using what we have. But what I think the key point to make here is are there some instances in which it gets really bad? Yes, of course there are, and we're seeing examples of some of those. But the sort of if we throw out the best and we throw out the worst and we just say how should we set our expectations after a decline of the kind we've just had? What should we think about that? Well, this chart, the last one I'm showing, is a bar graph for our listeners. What I'm showing here is I'm comparing both the mean and the median for each of these periods, the 3-month, 6-month, 12-month, 3-year, and 5-year. What I'm showing is both the mean and the median for these 11 11 to 14 instances, and then I'm showing, in addition, all the other days from 1950 forward, what the normal expectation is. So let me just explain this using the leftmost side of this. Remember, 63 days is the equivalent of about 3 months worth of trading. So on this left-hand group of 4, what do we see? We see in this blue bar that the median 3-month forward return from the day that 18% close occurred, or 18 or more percent of close occurred, is over the next 3 months, the median return is a 6.35% return. And the average return is slightly higher than that at 7.3. So how does that compare to how markets normally behave over those 72 years? Well, normally, the return over a 3-month period, the median return is only 2.6%, not 6.35, but 2.6. What does that tell us? Well, that tells us that there is around 3.75% more return after one of these 18% declines than we would otherwise normally expect. What about the gold bar here? That's moving from median to average. The average 3-month return over those 72 years is 2.2% versus 7.3%. Said differently, if the average is a useful guide, we could expect not only a normal market, but a 5% better result over the next 3 months than we would normally expect from the markets. And when we look at the 6-month, that contrast on the medians is about the same. It's just about 5% in both cases, but the mean return is actually 8.4% after these 18% declines, only 4.5% when for all days on average. And then I won't go in such detail for our listeners. I do encourage you again this time to download the graphs and pursue this a little bit further. But for our viewers, what you're seeing here quickly is that the median return for 1 year has 21% after this decline. The average return is 12.75 after one of these decline, whereas for all other times, the median and averages are at 10.25 and 9.25. Again, still better. And same thing is true on the 3-year. The one place where it gets to be a sort of a surprise is on the 5-year result. That's this group of 4 on the far right side. In the cases where there hasn't been the starting date wasn't, hey, we just had an 18% decline. What happens over the next 5 years from now? For all just normal days, that 5-year forward return median is 50% return. That's, by the way, not an annualized return. That's just a compound price return, or no, that's a straight line price return. And the average is 51%. But after these declines, it's only 30 and 37. Now, how is that explainable? I would say, again, it's a smaller sample. And in this case, it's even smaller for the 5-year because now none of the last 3 have triggered that. But I also would point out that it may signify that there's something else happening here, that after one of these declines, investors' thinking changes a little bit, and over the next few years, they're maybe thinking differently about their enthusiasm for the markets. It may be that they're thinking about positioning their portfolios differently. I'm not sure. Or it may be that there's something fundamental to the markets, or it may just be an anomaly of the data. I don't know. But nevertheless, I just thought it's interesting to see that in historical terms, what comes next has not normally been on the 3 month, 6 month, 12-month, and 3 year, just a disaster area. If anything, on both the median and the mean, it's been an improvement. Last thing I'll show, unless guys, if you have anything that you want to chime in here, I want to show this other graph from the Guide to the Markets. This is published by J.P. Morgan. And so, any comments about any of these before I shift over to this other graph, gentlemen?
I'll have my comments after you show the last
Yeah.
graph, but go ahead, Roshan.
Well, no, I've
All
got a
right.
few. I'll tell you my takeaway first is um, the data you pulled. You're not calling a bottom or anything like that. You're just saying when the markets are down 18%, here's what happens. To me,
Right.
that's valuable because that's essentially where we are now. That's why you picked that data point,
Yes.
and
Mm-hmm.
it's overwhelmingly positive when you go forward. Right. With that being
Mm-hmm.
said, just to put some numbers to it, and you're going back to 1950 on here, correct?
Correct.
Eric, so and I'm looking up right now how low that that market went, because that's included, and I've got so many tabs open. Just give me a second to find
Mm-hmm.
1950 exactly. So that was the bottom of 9. The bottom was in October of 1950. That market peaked in May 46, and its actual bottom was it actually declined 37%. I only picked that because I know that's a data point on the chart, but the point being, if you bought back in that market and it lined up with the averages um, from that 18%, you were okay and you were profitable in the long run, even though you lost another 19% first.
Yes, and so I don't have the data prior to January 3rd of 1950, so I'm blind. At least this data set is blind to what actually was the highest high before that. So, but subsequent to, if we
But
assume that January 3rd of 1950 was its own sort of artificial, we'll call it the high just because that's the first data that I have for this. The next
yeah,
instance of a downturn was not for another 7.5 years till October of
yeah.
1957.
Yeah, so and looking at that, and I've got all of them in here. Unfortunately, my data and your data doesn't quite line up exactly, but
Hmm.
I'm just picking a date after the 1950 recovery. So I'm looking at 68 to 70. That market decline was 35% from the peak being November of 68, the trough being June of 1970. And but my point sort of still stands, even though it lines up with your data. I'm looking at this market right now and I'm seeing deals, right?
Hmm.
I'm seeing buying opportunities. I'm also monitoring some investment great investors out there, and I'm just seeing how they're putting money to work. So
Hmm.
uh that makes me further feel like, okay, this isn't obviously this isn't good. We're down, the markets are down right now, but the other side of that coin is there's an opportunity, and the data set you presented really highlights that opportunity, even though and don't let me put words in your mouth or take your data a different direction, but even
Hmm.
though we're down 18% and there could be some more pain and some more decline on the way, on a historical context, even if you bought in now, you typically do really well and outperform as an investor. And as I said earlier, there are some opportunities and deals that the market is presenting right now.
Right. On a price return, just looking at this graph that we're seeing here, on a price return, you said it earlier, I am not making a market call. I am not saying that we have bottomed. I am not saying that the market is going to go up or down. Who knows? No one has a crystal ball. But if you just went with this, granted, smallish sample size and use that as the best guide that you have available to you for this sort of thing, you would say, just in purely probabilistic terms, from over these last 70 years, when something like this has happened, my 1 year average forward return on price alone, not including dividends, has been 12.75% versus 9.25% for all other times. That's a 3.5% bonus stemming from the starting point being an 18% decline. I would say at the very least, even if they were just identical, I would say what that tells us is the randomness of the markets means that you can't use the fact that we've had a decline of this magnitude as necessarily a guarantee that we're destined in the short term or in the long term for necessarily catastrophe in a portfolio.
Yeah, yeah, agreed. And let's actually go to that other chart that you have as well to share that. I know Adrian said he had some thoughts on that, and I was a fan
All
of
right.
that one in the preview.
Yes. Okay. Well, good. So this is, I want to give all due credit here to the JP Morgan, which publishes a guide to the markets. And for the public, it's available on a quarterly basis. You can go to their website and see a number of graphs that they maintain. They for financial professionals like ourselves, they offer a daily version of this. And so what we're seeing here is the version that goes through May 16th, 2022. And so what you're looking at is across this graph from left to right is 1980, the calendar year 1980, all the way to the point at which we have arrived so far in calendar year 2022. And you see both bars that are the gray bars, and then you see dots, the red dots. Let's talk about the red dots first. The red dots are the decline, the deepest intra-year decline that occurred in that calendar year from the prior high point that was of either that year or the prior year, but the highest intra-year decline. And what you're seeing, or the deepest intra-year decline, and what you're seeing on the right-hand side is that red dot is a minus 18%, which is precisely what we've been saying in the graphs that I was just showing you. And you can see there's quite a number of other years over these last 42 years, I should say, 43, I guess, inclusive of 1980, in which there's been declines of comparable magnitude, 17s, 18s, 20s. I'm seeing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, about 16, 17 of those, said differently, more than a third of the years have intra-year declines of that magnitude. So what's the end result? Well, the end result is the bars. And the bars show the end result from New Year's Eve of one year to New Year's Eve of that calendar year, how much in total return, including dividends, the S&P 500 increased. And so what you see, for example, 2 years ago in 2020, now granted, the Fed was heavily involved in that, fiscal stimulus was heavily involved in that, but the response to the COVID crisis took the intra-year decline to the minus 34% level. And then it rebounded and it ended the year 16% higher than where it began. And last year, slightly different story. The deepest intra-year decline was only a minus 5%, 5% down, and it ended 27% up. So far this year, we have had minus 18, but the year isn't over. At this point, we're down about minus 16, at least as of the 16th. We're a little higher again after a little better day again yesterday. But what this tells us is that it is not abnormal to have declines, intra-year declines of the magnitude we've had so far. And it can go further than that and still not necessarily mean that the market will end down as low as it prints on its lowest intra-year point. In fact, more often than not, actually, I would say almost universally, it's the case that the final result is far from that intra-year deepest print. Gentlemen, thanks for letting me share these graphs.
Well, thank you for pulling all this data together, Erik. I really appreciate it. I'm sure our listeners just have a lot to think about when you presented all this information to them.
Mm-hmm.
But it's a lot, but it's good information. Just having these data points to kind of take a look at what your own situation is and take a look at your portfolio. And that data chart that you just showed, a peak to trough, some of those declines were pretty scary numbers. And especially if you put those into context, if your portfolio was to experience that, that could be pretty shocking to some people. But those other graphs you showed, if you have that time, which we say is one of the most powerful things investors can have, is time. If you're able to write it out, there could be, so to speak, light at the end of the tunnel. But we also know that it could get worse from here. Just news could come out with Russia and Ukraine. It could get worse. Supply chain issues could get worse. Inflation can just be around for a while. Things can come out of nowhere that can cause these declines to happen again, which could be more difficult times. But again, just having this data that we're presenting you today is worth your while to kind of really look at it and just apply it to what your situation is, just like you said, Eric, to help you manage your expectations. And this data by no means is going to predict what's going to happen in the future, because like I said, stuff can come out all the time, or news can come out that can cause the markets to go down more, especially the equity markets. So having this data is very valuable, where I'm the type of person, I kind of like to know what's the worst case scenario and what's the best case scenario. And let's try and figure out a way to manage both of those and find somewhere where in the middle. I think that's really important. And then the aspect of just risk tolerance or risk capacity is really big here, because these these charts that we're showing you are the equity markets. And if you're somebody that has a lot of exposure now to equities, and you're seeing this data that Eric's presenting you today, and you're like, wow, maybe I could have taken on a lot of that when I was younger or previous years before, but now I'm not comfortable with that. Now may be a time to upgrade your portfolio, update it. There are new opportunities out there, or investments that have worked really well for you in the past might not be headed for that same way in the future right now. So looking for opportunities is really good, especially when there's market volatility. You can pretty much try and make money in any type of market environment, but you have to do the research. You have to look at the data and really dig in deep, or just have conversations with people and see what might be the best fit for you. But when market volatility hits, you definitely have to buckle down, look at opportunities, look at your overall strategy and your portfolio to see how you can weather future storms, or how you can take advantage of opportunities. I think is a really good concept when you're presenting data like this, Eric. I know I'm gonna have to spend some more time with all the charts that you showed us, and I'm really happy to, because it's really valuable information if you apply it to your situation.
Yeah,
Yeah,
agreed.
actually, and I want to read something from that chart, Eric. I think it's very valuable and a good summary. The Under the heading, you've got the title of the chart, and underneath that it says, despite average intra-year drops of 14%, annual returns were positive in 32 of 42 years. Right? So that literally is just written right on that JP Morgan chart that you said, and I think that's a great summary of, the point we're trying to get across, not necessarily tied to the numbers of the data or the data points, but that, yes, things are down, look at the opportunities that are available, and you'll get to the other side, Adrian, as you said, the light at the end of the tunnel. Let's talk about that now. What are some thoughts or ideas on how you can, handle this and not do anything too crazy during this market decline? How do you deal with the volatility? So, gentlemen, I'll let either of you jump in and start us off.
Well, cash is a dry powder right now. So people are looking at that cash that they have set aside in their portfolio. And like you said, looking for opportunities. I think that's one of the biggest thing right now. I mean, Eric, you mentioned it. Normally the 60-40 approach right now isn't doing so well, where equities are getting hit and bonds are getting hit, where if you have some cash as a portion of that as well, that's pretty much staying stable, but it's losing out to inflation, which is not good. But still, having this cash available right now is very valuable in market volatility, because you can look for those those opportunities. And like I mentioned, just upgrading your portfolio. If you have these stocks that done really well, that aren't doing well, maybe you look at other areas. If you have these bonds that are long term that are just getting hit really hard by interest rate, maybe look at shorter ones. Just looking deeper into individual asset classes, see where you can make changes is good. And like Roshan, to answer your question, just cash right now is no better time to look at your cash than when markets are going up and down, just seeing if you can finally put that to work if it's been off to the side for some time.
Yeah, and Adrian, just
Yeah.
to clarify for the listeners, you're not saying go to cash. You're saying utilize your cash now to try to take advantage
Yeah,
of
exactly.
opportunities. Correct? That might
That's
be worth
why
looking
people have been
into.
saying the dry powder is what they're calling this cash right now. Just being able to use it and just again looking at your entire portfolio too, not just the cash, and seeing where you can just make some changes right now. Just fine tune the edges of your portfolio could be really valuable.
Yeah, so I want to make a distinction between those that are pretty far from retirement and then those that are actually living off of their portfolios. So for those of our listeners that are uh, many years left before you'll have to actually start accessing those funds, just remember that volatility is not in the final analysis anything much more than discomfort. In that it's the end result from a total compounding standpoint that is what you should be driving your thinking, not necessarily am I happy or unhappy with the movement of my portfolio, because in that sense it's not consequential. Now, if on the other hand, I'm going to swing back around to you as well in just a moment, because having said that and presenting the data, the reason we're presenting all of these data today is specifically to provide you with the sort of conceptual and intellectual capacity or resources to speak to your emotions when your emotions are ruling the day. Hopefully, your mind will have some content that you can bring to your emotions and straighten them out. But if you're saying, Eric, it's just not working for me, then I'll have some thoughts for you in just a moment. For those of our clients, though, that are at this point very, very close to or already living off of their portfolio, we do acknowledge that volatility isn't your friend. It's not merely discomfort. It does have a consequence depending on when you're pulling from your portfolio and the rate at which you're pulling from your portfolio. And so in your case, if you're thinking, Eric, oof, this is just really, really not merely just extremely disruptive to me, but it's also got me concerned about whether I'm going to be able to sustainably fund what I'm doing, then I have a few thoughts for you. Roshan and Adrian may completely disagree with me. That's part of the beauty of having three people here to do this. But I would say, in general, you might want to look at some ways to subdue the volatility in your portfolio, and returning to a concept that we introduced last fall in the use of something known as the high yield spread indicator that was developed by the people we so respect, Dan Rasmussen and the others at Verdad Capital. That metric has indeed recently signaled that the anxiety level among fixed income investors has grown to the point that it is now higher than has been normally the case over the last decade, and it's rising. And so, on that basis, their findings and mine as well, when I attempted to do some confirming research on this, showed that in moments like this, it is the case that equities do somewhat struggle for a while. So, here's a way that you could think about, without doing a wholesale moving of your portfolio to cash, you could think about the following. And just so that you understand, this is not a broad prescription for everyone. It's something for you to consider, to if you're self-directed, to evaluate on your own. If you work with an advisor, to talk with this advisor about this concept. If you don't have an advisor but you'd like to speak to us, of course you can reach out to us. Our contact information is in the show notes and at the website retirementlifestyleshow.com. But here's a thing you could think about doing. On the bond side, here's my view, gentlemen. You may disagree with this. I think the market has probably priced in the announced increases in interest rates by the Federal Reserve. I think it's either priced them in or it's close to price them in. My assessment, though, is that before it's over, I think it's likely, and this is completely my opinion. So this is very subjective, but I think before it's over, the Fed is going to find that it needs to raise rates even more than it has indicated so far that it will do. And in order to tamp down the inflation, because we're right now in a situation, it feels to me like the Federal Reserve is like a fire truck out front of your house on fire, trying to put out the inflation fire, whereas the administration is in the backyard spraying kerosene on the house, trying to look for every way they possibly can to spend more money. So on this basis, I think it's it's a battle that's going to require more effort on the part of the Fed. You like that, Roshan? So
I like the analogy, but it makes me worried because if the house is on fire, it kind of seems like it's already too late to do anything. So,
well, you get the analogy. So I think at this the bond market is probably not priced in what I believe is probably more interest rates ahead. And so for that reason, I would say you could think about shifting the bond composition of your portfolio either to more shorter and higher quality composition and less in more speculative grades or longer dated maturities, or even move to some of the alternatives that we talked about in our bond alternative episode last fall. You can find that show there. So I'm having conversations with clients about some bond alternatives. On the stock side, if you're thinking, I don't want to do a wholesale repositioning of my stock portfolio, and I can understand why you wouldn't, you might want to use some of the proceeds from the sale of your longer dated and lower quality bonds and use that to put on some short positions for a short for not a not a permanent short position, but have some short positions in your portfolio against either an index or against some of the specific names that look like they're the weakest, and use some shorting to have a net reduction in your overall equity exposure. Now, again, those are ideas, not recommendations. Those are the thoughts for you. Roshan and Adrian, now you can say, Erik, that's the stupidest thing I've ever heard. Go ahead.
Well,
I'd
I
never
would
say
actually just
something
want to
like that to
go
you,
and just
Erik.
explain. Yeah. Yeah, and I'd want to just explain a little bit further what short positions are. You can
Hmm.
buy either ETFs or mutual funds that profit on a market decline. So what Eric's saying is, let's just say you had, just because you referenced this earlier, a 60% stock, 40% bond portfolio, and if you reposition those bonds, that 40% into those short positions Eric mentioned, well, now you've only got a 20% stock portfolio because you've got 60% in stock, makes money on the way up, 40% in a short that makes money if the stock's on the way down. So that 40% offsets the 60. So that's what Eric said. What I actually think stands out and I find interesting is the house analogy and the Fed. And I'll tell you why. I think we're only 1 month into this, but there is one month's worth of very, very small data or very change that goes back to say inflation might be starting to get under control. If that's the
Hmm.
case, not that I think the Fed will change their course, I think that could be an argument against, Eric, what you said about the Fed needing to raise
Hmm.
rates more than they've planned. And
Hmm.
second, to the government spending aspect, we seem to have gridlock in DC, which has become the norm for the majority of administrations over the last 20
Hmm.
plus years, which would mean that that spending or that kerosene can't be thrown on the house. Thoughts on that?
I completely
That
agree with that. If we do
alternative
have
perspective.
yeah, no, and at the midterms in particular, I think it is it's likely the case. Although 6 months is a long, long time until those midterms, and a
But
lot could change between now and then. But I do think if we do have divided government, that the historic pattern is in those moments that there's much less spending done during the periods of divided government. So
Well, aren't
what
we
I'm
kind of
just
divided
noting here,
now?
and
I
mm-hmm. Well, so with Manchin sort of often voting against his own party, I see that, and
yeah,
Sinema sometimes voting against her own party, I see that. That
yes.
said, the administration does have other means of releasing funds, and they have been talking about one such means in the idea of forgiving, quote unquote, which is not forgiving; it's just transferring, but forgiving student debt at some level. It may not be all student debt, probably won't be all student debt. It might be some student debt up to a dollar amount. It might be student debt up to a dollar amount for some student borrowers. One way or the other, though, just in the same way that the moratorium, that extended moratorium on rental on evictions led some, not all, but some people to then refrain from paying their mortgages. In this case also, if you inject this, what were funds that were directed toward the reduction of student loan obligations, now that cash is freed to go do other things. That's another infusion of spending, even though it's not earmarked per se as a bill that went through Congress to pass that.
So uh, I can see your perspective, and I'm not by any means saying you're wrong, but
Hmm.
I also don't know at this point that I lean towards that, right? And I and
Okay, that's
I
fine. Hmm.
hmm, yeah,
That's
I
why I
don't
like this
know. It's
conversation,
interesting
because we
conversation.
have different perspectives. Hmm.
Well, and I'm also maybe I'm definitely optimistic about where things are headed. Right. So, and what I mean by that is right now, I believe, and I feel free to disagree, but everything's driven by inflation and the Fed. Even the Russia invasion of Ukraine had a little bit of an impact, and the markets actually bounced up after that. But I believe the markets only bounced up because the Fed had to cut how much they were, instead of raising at a half point in March, they raised it a quarter point. So if inflation
Hmm.
slows, as I think we're seeing very, very early signs, just with the April data being, I believe it was 1/10 better than March. It may have been 2/10, but
Hmm.
very
Yeah.
slight improvement.
Hmm.
And I'm hoping that that's the start of a trend, which would then mean that your scenario, the Fed raising more than they have to, or than they've discussed, will slow down. So it might just be me looking at the glass half full and being hopeful. But I think if your
Hmm.
scenario is right, I think we are in for a lot more pain. There was a recent statement. I'm going to pull this up by a Bank of America, I believe it was their chief market strategist at Bank of America, where he had said that the average decline of the last 19 bear markets was 37%. I'm paraphrasing, but his quote was, "If history repeats itself, then the bear market today doesn't end until October, and the S&P goes down to 3,000, which would be another 25% decline." So
Hmm.
if in your scenario, or your description, excuse me, I think would line up with that completely. Uh, but I think it's all inflation driven. And just to give credit to the source, that was Michael Hartnett, with that's Bank of America's chief investment officer, that had that quote. And I can
Mm.
I think your scenario and what he said lines up, but I also look at it and think he's just pulling historical averages and throwing it out there.
Yeah. Well, that's
So,
interesting. The historic
going,
average, it sounds like he was probably using data going all the way back to 1928 or earlier.
yeah, yeah, I believe I believe that you'd have to, for that percentage decline, go back to the Great Depression. Um,
Hmm.
but let's go back to, I want to take us back to what you've got to do. And Adrian, you touched on this as well. Uh, you may have mentioned this earlier at the beginning, but I think a lot of the answer here goes to the behavioral finance aspect of things. And I'll just throw a couple things out that this is from American Funds, or the Capital Group. They've got some thoughts on it. U.S. Bank has some good ones out there. So, gentlemen, I'm going to throw a few things out there and just get your thoughts. So, The first thing from the Capital Group or American Funds list for dealing with volatility is invest regularly in good times and bad. I won't ask you for too much on that. I'm going to ask you to share your thoughts on the next one. This one, invest regularly in good times and bad. They just talk about how if you are still working or putting money in your 401k, you're putting in on an ongoing basis. I think this could line up with repositioning your portfolio, as both of you discussed, but doing it gradually versus all at once. Their next point, which I think is very powerful, is they say
Well,
avoid
wait, before you leave
jumping
that,
in and out of the markets. Yes.
yeah, so before you leave that, let me just say, my kids are in their early 30s, and I'm telling them, despite what may be a difficult period or a challenging period over the next decade or so for the markets, they should be celebrating it. They should actually, if they're in mildly selfishly, they should be sort of hoping, keeping their fingers crossed that markets are really challenging for a couple decades so that they can really pack away their savings and invest in these markets while share prices are becoming increasingly, we would presume, justifiable by growing earnings, even though there might be not equally rapidly growing stock prices. So, and for younger people, a challenging market or an underpriced market would be just an absolute boon.
Yeah, that's the time advantage that
Yeah.
I mentioned, having so long to you need these assets and withdrawing them when you are retired is extremely important, especially if the market's so low. Just contributing to that 401k and buying at these low prices, and those charts that you showed over time, it seems to work in their favor. Yeah, it's really
Hmm.
good. What was the
Hmm.
next point you brought up,
Yeah.
Roshan?
And actually, Adrian, you also mentioned this that I think lines up with what Eric said is the taking your cash and looking at this as an opportunity to invest as well. The next one says avoid jumping in and out of the market. I'll let either of
Yeah,
you
that's
start
just
on that one.
the
Feel
timing
free to jump
aspect.
in.
Just timing the market is extremely difficult, and just trying to buy low and sell highs. It's just it's really difficult to be able to come out profitable on that. Just finding a
Yeah, you've got to
strategy
be.
or sticking to your principles is really good at the end of the day than trying just to time bottoms or tops. Just having strategy in place, it seems to be more valuable over the long term.
Yeah, you've got to be right twice, right? You got to be right when you get out and right when you get back in with this. And unfortunately, unless you've got some kind of uh, system in place where you've done this before successfully or done some kind of research, I'm personally not aware of any that has a high success rate with this level of timing. But uh, the the point being, you're guessing, right? You're just guessing is it going to keep going down or keep going up in most instances. The next thing they've got on here for dealing with volatility or maintaining your sanity during this environment is maintain a diversified portfolio, right? And with here, they're talking about not only different asset classes, not just stocks, bonds, not just U.S. and international, but I've also seen it broken down to different sectors or different parts of the market that does well. Now, another list I've got for us is the U.S. bank list, and that's where they talk about, and their example is industrial stocks may do well when the economy is booming, but not when things turn down. On the other hand, consumer staples, those stocks that sell everyday goods, can do better through a recession. So here's where the diversification aspect one, you want to handle it before, but I just want to make the point that it doesn't have to be just stocks versus bonds or just this US versus international. You can go down further and diversify your portfolio by those specific holdings.
Well, it's true that the three sectors in particular that seem to hold up better than other sectors are utilities, because people still heat and cool their homes when times are hard, consumer staples, because they still brush their teeth and put on their deodorant and shampoo their hair when times are hard, and healthcare, because they're workplace based or they're Medicare based premiums into those healthcare companies, those are still flowing even when times are hard. So there's that. I'm seeing, as I've mentioned, I think in at least the last couple of podcasts, that one of the momentum strategies that I run has completely moved over to consumer staples, to energy sector, and to commodities broadly speaking, including agriculture. And then in the stock strategies that I run, the overwhelmingly the ones that actually, the large cap value strategy is still net positive for the year, and that is largely explainable by its having sought out, just by the nature of its algorithms, last November, last February, and previous quarters before that. It had sought out these resource based, natural resource based companies, and materials companies, and uh, things of that kind. So it is interesting that there are indeed pockets of the overall investment universe that are not just kind of hanging in there; they're actually thriving.
Okay, I can summarize then some of the points we just touched on. Invest regularly in good and bad times. This was the 401k example where if you keep contributing during when the market's going down, you can build up shares, and just being buying low can really benefit you in the long run. The next one is avoid jumping in and out of the market. Again, that's timing where Roshan mentioned you have to be right twice, which can be difficult. The next one we touched on is maintain a diversified portfolio and go beyond just investing in stocks and bonds, where you can diversify within those asset classes and different industries and sectors. If you're looking at equities, can be very beneficial for you. And then the next point is don't forget history. And we touched on this a lot with some of that data you showed, right, Eric?
Yeah, yeah, absolutely.
So that was a really good one. So we'll skip that one for now. And then the next one is expect and accept volatility. What does that kind of mean to you guys?
Well, I would start with what we talked about earlier, and what our data showed, that this is part of the market. It's par for the course. It's normal. So don't be surprised by it when you see this volatility. And that's the expect side of it. The accept to me means that um, not only should you uh, accept it and know that's a part of what's going to happen, but if you do that and you accept it, you can potentially take advantage of it, which we also touched on earlier.
Hmm. Absolutely. Yeah, go ahead, Adrian.
Yeah, excellent. And then the last point and the last thing we can touch on is stick to your plan. And I think this is a great one. Don't let volatility deter you from the course that you're on. If you have the right strategies and the right plan in place, this can kind of go to the last point we talked about, is you can kind of expect and accept volatility when it comes your way. If you have a nice plan set in place that you review annually, and it incorporates and expects times of volatility. And don't let that deter you where you're updating your strategies or trying to make adjustments based on volatility. So being able to stick to your principles and the strategies that you have can really help manage your emotions, make you more comfortable when times of volatility approach.
Here,
Yeah,
here.
agreed.
I
And
agree with
and
that.
I would just extend that with stick to your plan. To me, it's not just your investment plan, it's your financial plan, which to me it really is the anchor in a time like this, right? It's our let me use a better analogy. I think that's your guiding light, or your lighthouse in a time like this, right? Where you can focus on that. So I know as we've been doing in our meetings with clients, we're updating their plans to show them, here's where you stand now in spite of this decline. And if they're in many cases still on track and everything looks fine, I'd say, nothing to worry about. Everything looks good. If there are some that are no longer on track or we need to adjust, we come up with a plan, and we're making that plan in what I think uh, is the majority of the decline already happening, right? So things will look that much better for them on the other side.
Yeah, I don't have anything to add to that. It's point well taken.
Excellent, guys. I think we covered this topic at length. We shared history on volatility to put it in context for everybody. We've also shared with you some thoughts on how to deal with it, how to manage your emotions. That's the behavioral finance side of things. Um, Thank you for joining us. We know we've got a lot of information for you today, and we had a lot of charts and data. We hope you actually find that helpful. I know that I do when we're looking into
Hmm.
the future. Please, if you have questions or need help with us, you can reach out to myself, Adrian, or Eric. All of our contact information is in the show notes. All of our previous episodes that we've referenced can be found on our website, retirementlifestyleshow.com. Finally, please like, subscribe, give us 5 stars, tell your friends and family about us, and we'll be back next week for another great episode. Thanks for joining us. This has been the Retirement Lifestyle Show.